Last week's inflation result has all but eliminated the chance of another interest rate cut in the foreseeable future. Yet our major capital city property markets continue to show significant strength. Look, as somebody interested in property, you're likely to want to know what the inflation results mean for our housing markets. And that's what we're going to discuss today as Dr. Andrew Wilson gives his outlook on the housing markets state by state. Now, the federal government's insisted that it's been devoting considerable resources towards fighting inflation, and the Reserve Bank pushed up interest rates 12 times between May 2022 and December 2023 to ensure it did what was necessary to keep the inflation from running away. And yet, last week, the Bureau of Statistics reported that underlying or core inflation, having gradually declined over the last years, turned around and headed back up. Now, many fingers are pointing at the rising cost of electricity. So to understand what's really going on with inflation and what that's going to mean for our housing markets, I'm going to ask Dr. Andrew Wilson to unpack the latest data. So welcome to this week's Property Insider, where Australia's leading housing economist, Dr. Andrew Wilson, and I take a peek behind the headlines to uncover what's really going on in Australia's property markets. Each week, we're going to share with you ideas, trends, and insights the mainstream media often misses, helping you make smarter, more confident investment decisions based on facts, not fear. Whether you're an investor, home buyer, or simply property curious, we're going to tell you what's really behind the stories. So, Andrew, inflation wasn't the only scary thing. Halloween was scary last Friday, but inflation came in even earlier.
Yeah, what's Halloween, Michael? I'm not sure. But anyway, they seem to celebrate it in larger numbers every year in Australia.
Every year. Trick or treat, Andrew.
Are we captured by American culture? I'm not sure. But it certainly can point to that. But I think there was a lot more to be fearful from those latest inflation numbers because, and I'm a little bemused by all this shock horror about all higher inflation. We've seen this coming and we've discussed it here a number of months now, and logic would have told you that this was going to occur. We've had the benefit of lower oil prices, which has been the main cause in lower inflation over the past 2 years. Nothing to do really with higher interest rates. I'm not sure that we can really have a correlation between those increases in interest rates you mentioned and the falling rate of inflation, because that was really about lower petrol prices. And of course, the other factor, which is a significant part of the basket of goods that the ABS measures for inflation, was lower electricity prices.
Correct.
And
yes.
How did we get lower electricity prices? Well, the government gave us the big handout. And are we surprised that when the handout finished, inflation starts heading north again? And it will continue to do so on the back of higher electricity costs. Now, this is a bit of a gotcha moment, I believe, for both the government and the Reserve Bank, because who's asleep at the wheel of the Reserve Bank? Because this was going to always happen, because there was a finite policy for those electricity handouts that was always going to end. It has ended. It's been replaced by, a subsidy light, we could call it, and that will be finishing at the end of this year. And of course, that means, that now with no real sign of reduced electricity costs, organic electricity costs, in other words, the transition from the carbon economy to renewables is certainly not yet resulting in lower electricity prices. And I think there is some way to go before that occurs. And this isn't just a problem in Australia. This is a problem in most other advanced economies, that the transition period from the carbon economy into renewables is taking longer and costing more than was originally, speculated on. Maybe there was a lot of politics in that, maybe not. But Australians will have to be digging deeper into their pockets to pay their electricity bills, unless the government, of course, comes out and gives us another handout. But does that mean the taxpayer will have to continue to fund this transition period from the carbon economy to renewables just to save us all from Armageddon in terms of either skyrocketing electricity prices or, blackouts when we have high loads of electricity because of lack of capacity? But this is important for the housing market. Obviously, it's important for everybody in terms of...
Andrew, just to interrupt for a sec, you're thinking that persistently high energy costs are going to keep driving inflation in the future unless something changes.
That's right. And the only thing that can change is another handout. And that will prove to be very, very expensive in terms of the quantum involved, and also will have a significant impact on other government policies. and programs. And as I said, I think that's the only way out of this, because we're not going to get the relief in terms of that transition to renewables, in terms of lower electricity price or even steady electricity prices going forward. And as I said, we're not alone here, Michael. The US, the UK, Europe are all suffering from this, from higher electricity costs and prices because of the stagnant nature of this of this transition period out of the carbon economy.
Well, this chart that we're showing shows that electricity and fuel are actually the key components to rising inflation. All the other things other things don't make much difference.
Well, they don't, Michael, particularly when there's a lot of volatility and certainly a lot of growth in those particular services. We look at the data itself. As I said, I don't know why we've got all this shock, horror, surprise that we've had this spike in inflation, because we've known this was going to happen. I don't know who's in charge of economic policy at the Reserve Bank or analysis, but they must have known that the end of the subsidy from the government would result in higher electricity prices. And we've seen that when the major subsidy finished because it ended over the last financial year, when it finished in July, of course, and we saw the July inflation numbers, Michael, and we commented on that there was a big rise in electricity, another one in August. And of course, that was followed up with the data last week that announced yet another one in September. So, I mean, we must have known this was going to happen, but there was no preview of this or the prospect of this in the commentary from the Reserve Bank in terms of its outlook for interest rates and inflation. And of course, we are focused here on the property market. And this data is very important because it does determine what's going to happen with interest rates. And of course, we've seen the result of interest rate changes, particularly this year, when we've had 3 cuts. And I think we've got some question marks over those cuts now, given the breakout in the inflation. Maybe we've had 1 or 2 cuts sort of brought forward, which is good news for property owners, because as we'll see at the end here, we've had some tremendous growth in house prices. So property owners, personal wealth has increased on that basis. But, what does it mean going forward in terms of the fight against inflation? I don't think we're talking about higher interest rates here, because how would higher interest rates, Michael, stop the rising price of electricity? What are we going to do? Say, well, we can't afford to pay to have electricity anymore. It's not going to do anything. And just as I said, those higher interest rates really didn't have an effect on inflation over that period where we did have the highest since the early 70s. It was falling oil prices and then falling electricity prices, which had nothing to do with higher interest rates at the time. So as there's some big question marks here for our policymakers, for either having a bit of a snooze or just wishing and hoping that the other factors would moderate what was always going to be a breakout as a result of electricity prices. But if we look at the data, Michael, that was released last week, we had September quarter, and of course there's some other interesting factors here that we'll not be seeing the quarterly data anymore.
No.
Monthly data from now on, which is a good thing. And Australia's finally caught up with the rest of the world, or advanced economies, having a monthly inflation result rather than a quarterly one. And it's
Will be more detailed monthly reports, Andrew. Is that correct?
That's right. Well, they've had to, remodel everything on a monthly basis. So that's taken some time. It's taken the best part of 2 years for this to occur. But really, we've been behind the curve for so long compared to other advanced economies with this antiquated measure of inflation, quarterly measure inflation, because by the time the measure comes out, it's 3 months past since the beginning of the measure. So, really, a lot of really serious questions here, but we will be at least shelving the quarterly result and going to a monthly result. As you said, Michael, it's now fully comprehensive according to the ABS inflation measure, but the monthly measures have given us a really good indication anyway of where the quarterly data sets were going, and that was revealed once again last week with the latest September quarter and September monthly inflation results. But we will be having monthly from now. But the Reserve Bank has been relying on, that's its primary measure, the underlying inflation rate for the quarterly measure. So it will be now looking at the monthly measure. And if we look at that, we can see that those interest rate cuts that we had this year, we had them in February, we had them in May, and we had them in August, followed the release of the quarterly inflation data. So no longer will be that. So that'll be interesting how the Reserve Bank cope with it. But when we broke down the latest numbers, Michael, We saw that the September quarter headline inflation rate rose. In fact, it skyrocketed from 2.1% to 3.2%. So outside the target range there, and the target range for the Reserve Bank, of course, is 2 to 3%. But that's on the underlying measure. But the headline measure, which takes all the basket of goods that are counted for inflation into consideration, up from 2.1 to 3.2%. Underlying inflation was also up from 2.7% to 3%. So still within the target range, but right on the limit of the target range, Michael. Let's remember also, the Reserve Bank has been telling us, the governor has been telling us for quite some time, that the target was to consistently be in the midpoint of the target range. So not within the target range, but within at the midpoint and consistently in the midpoint. Well, we've never really been there, Michael. And yet we got 3 interest rate cuts at the beginning of this year. Quite extraordinary. So the data is telling us now that, yes, we're still in the quarterly data set, we're within the target range, but right on the outside of that target range at 3%. We saw goods inflation up from 1.3% to 3% as a result of higher electricity costs. Services inflation was up from 3.3% to 3.5%. When we do look at the chart, we can see how that has now spiked at 3%, that quarterly annual growth in underlying inflation that takes out some of the volatile elements. But we won't be looking at this chart from now on, Michael, because it's going to be a monthly data set. So let's have a look at what happened over the month of September, because that certainly gives us, more of a current insight into what's happening with inflation. And if we had the quarterly, obviously this is what's translated into that higher quarterly number. But when we look at the monthly number, Michael, it's really quite profound. Headline inflation was up to 3.5% from 3% in August. Underlying inflation was up to 2.8% from 2.6%. But when we see the breakdown, Michael, it really does tell us the story. As I've said, we've seen monthly inflation or prices of electricity rising over the past 2 months. So no surprise that continued. And we went from an annual rise of 24.6% over August in electricity prices to a rise of, hang on to your hat, 33.9% increase, Michael.
I thought that was a typo when I first saw that, Andrew.
Why wouldn't you? But you can see the trend is upwards and upwards. What are we going to get next month? And of course, we've still got the advantage currently of the lesser subsidy from the government. We're still getting subsidised electricity from the Commonwealth and also from some of the state governments. But that subsidy is due to end at the end of this year. Now, will the government hold its nerve and get rid of that subsidy as it proposed at the moment? Or will it just obviously reintroduce it at that level or higher? Because you can imagine, Michael, next year what electricity costs will be, because these electricity cost increases in inflation are still being moderated by the subsidy as it exists now. If it's not there, you can imagine given what the full subsidy was, what it will be over the first 6 months of next year when we don't have a subsidy, but we're comparing it to the full subsidy discounts of this year, early this year. It'll be, extremely high. And this is going to be a very interesting period for the government and, certainly for the Reserve Bank in terms of its outlook. And as I said, there are some serious questions that the Reserve Bank has to answer here about why it was until recently, the last month's data, that it was saying, maybe inflation is going to start to rise again. And I mean, of course, we were going to see that once that subsidy finished, which was, we all knew. But other factors that were also impacted inflation, fuel prices actually went the other way. They've been falling consistently for quite some time, Michael, as we've discussed here. They went from a 1.7% fall over August to actually a rise of 2.8%. But we'll look at fuel in a minute to see what the prospects are there. Rents actually started to pick up a bit, Michael, and we've been sort of predicting that might start to occur given consistently tight vacancy rates in our rental markets. But they went from a rise annually over August of 3.7% to 3.8%. And when we look at the chart for monthly underlying inflation, you can quite clearly see on that underlying inflation chart, Michael, that the trend has been rising now for quite some time. Well, certainly over the last 3 months. And as I said, this data has been available I'm not sure. And I know it was almost, laughable that there were sections of the media with the clickbait headlines about shock inflation result, like this wasn't to be anticipated. And as we've discussed here, that was likely to occur. We know there also that oil has affected the inflation rate, as I mentioned. When we look at inflation versus the oil price, we can see how as the oil price fell from its peak back in 2022, as supply lines adjusted post-COVID, that we've also followed downwards. But it's been electricity recently that started to push up the CPI. But the good news is, Michael, in terms of the impact of oil on the inflation rate, that actually oil is tracking lower it did over October compared to October last year. So maybe the offset for overall inflation will be a lower oil price, which will help to moderate higher inflation as a result of higher electricity prices. But we're in the lap of the gods here, Michael. I mean, it's a mug's game to predict where oil is going to go because that's a volatile scenario. But it certainly has been on a downward trend lately, and it's tracking well below where it was a year ago. So that will be good news for our inflation rate. As I said, helping to moderate what will be certainly, with the current scenarios, higher electricity prices. And when we look at the electricity, we've got a chart here, Michael, that looks at electricity versus inflation. We can quite clearly see how those lower electricity prices as a result of the subsidy pushed inflation down. And as the subsidy has waned, electricity prices have increased. And with the removal of the full subsidy at the end of the last financial year, we can see how electricity prices have skyrocketed and inflation has skyrocketed. And with also the chart reveals what the inflation target is. As I said, the midpoint of 2 to 3%, and how it's now tracking above that. Now, that's not, I wouldn't suggest a very sophisticated chart, Michael. I'm a little surprised that there hasn't been some sort of an insight looking at that relationship that would have given more of a substantial commentary on inflation, on electricity, and the prospect for interest rates. As I said, I don't think there's for me, logically, I can't see any reason for higher interest rates with an inflationary breakdown. It wouldn't make any difference at all. It would only impact the business cycle, which is already looking like it's starting to peak, although it's still strong. It's just that I guess we've got to sit back and, if you're a homeowner, take advantage of what these lower interest rates have done in terms of creating plenty of momentum in our property markets, Michael.
Well, let's talk about the property markets, Andrew, because only a few days ago we had your My Housing Market end of month reports, and all the housing markets around Australia, apartments, and all the houses in particular, and most apartment markets did well. But you've got some charts to show us about what you think the outlook is. So let's work through those, please.
Well, unique to My Housing Market, Michael, we actually track house prices on a daily basis, and they're actual prices. It's not an index number. What we're doing here is using a quarterly measure, but we're advancing that day by day as the data comes through. And what it does is it reveals on that daily basis, and you're seeing it, I guess, in a way the first time here, what it does is it reveals clearly what the trends are. As I said, it's daily. So because of that, we can see the direction of the market quite clearly, and it's quite interesting when we look at that. We'll look at the Sydney one, and you can see there consistent growth in Sydney, and they're all similar because they do show a breakout in activity from those first interest rate cuts, or from those interest rate cuts, particularly at the beginning of this year. But the Sydney market has been onwards and upwards, and still quite a clear trend there. So we can see there that Sydney market is rising. Melbourne's very interesting, Michael, because we can see that Melbourne market has really been stagnant for a significant period of time, a couple of years, but those lower interest rates this year have reactivated the Melbourne market, and it's certainly clearly on the rise there. When we look at the daily house prices, the Brisbane market, that's really revealing, because different to some fluctuations in Sydney and Melbourne, we've just seen really a consistent rise from that Brisbane housing market. It eased during that higher interest rate period, Michael, but once confidence returned to that market, as well as high levels of migration, interstate migration, we've seen prices in Brisbane, for Brisbane houses, just continuing to rise, and rising at a very strong rate at the moment. Adelaide, similar. It's interesting with Adelaide. When we look at Adelaide, we can see Adelaide was a very strong market through the latter part of last year, but it did tend to peak out. And that was a bit of a cyclical easing, Michael, that we do see because affordability barriers increase through high prices. But again, that the Adelaide market was refueled by lower interest rates, and it's been rising quite strongly since those lower interest rates. The Perth market, similar to Adelaide, it was the strongest market in the country last year, but it started to taper off because of high prices, creating affordability barriers. But again, refueled the Perth market by those lower interest rates. And when we look at the unit markets, the major unit markets here, Michael, Sydney unit market rising not quite as quickly as houses if we compare those two trends with the two slopes of the models, but certainly rising this year, similar to houses. The Melbourne market Melbourne units are now rising at a stronger rate than Sydney units. So Melbourne is now broken free of Sydney in terms of unit prices, although of course their prices are well below the Sydney unit price
Yes.
In terms of the median. But a very strong revival there in Melbourne unit prices. But again, similar to houses, they are coming from a period of significant or lack of growth going forward, but confidence returning to the unit market in Melbourne, same as the house market. And Brisbane, well, Brisbane just doesn't have any sort of fluctuations, Michael.
No.
It's just onwards and upwards, and that is quite a remarkable result there. You'd be very happy if that was your wealth chart for capital growth. It's
Yes.
property, wouldn't you, Michael? Just sign of any downward movement over the longer term. I think it's interesting to compare that. It is a daily chart, so it shows you the fluctuations. It gives you a very clear sign of where our markets are here and now, and of course, the trend going forward. So I think it's a good forward indicator of the prospects of our housing markets. And as I said, you'll only see it here, a daily measure of actual prices going forward.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Fantastic. Now, you said it's a good measure of our housing markets moving forward. Another one, of course, is what happens over the weekends at auctions, which is a good in-time indicator. Now, again, there are always interruptions, and there was this weekend with the Melbourne Cup weekend, and even though Melbourne had a long weekend for many people, it does affect the nation in other ways as well. But how did the auctions go over the weekend?
Well, interestingly, we did have a surge, except for Melbourne, of course, as you mentioned, Michael, which has a long weekend. We had higher numbers of auctions across the board, except for
Yes.
Melbourne, and market really didn't miss a beat. In fact, if anything, we had higher clearance rates. So the rule of more listings, lower clearance rates, which we know is nonsense, certainly was revealed by that generally on the weekend. If we look at Sydney, 1,483 auctions in Sydney, that's a big number for Sydney.
Yes.
One of the biggest numbers of the year, and it's clear and well up 200 up plus on the week before, and the clearance rate just a slightly low, but still a very positive clearance rate there for sellers. Again, around 10% higher than a year ago, Michael. So, and also higher auction numbers. Melbourne, just a handful of auctions for Melbourne, 597 because of that cut long weekend. Clearance rates picked up quite strongly, mid-70s again in Melbourne, which was well above the weekend before, which of course was their Super Saturday week of auctions where they hosted the biggest number of auctions for the year. And, maybe proving the point that certainly at some point, higher listing numbers will push down the clearance rate. Melbourne is still tracking about 10% higher, similar to Sydney, than a year ago. Similar auction numbers. Brisbane, big weekend in auction also for auctions in Brisbane. Good result there for Brisbane. As we know, anything above 50% in Brisbane really shows a growing market and well above where it was a year ago, although auction numbers were lower. Same story in Adelaide, similar auction numbers, similar clearance rate, but again, higher than a year ago, which was when we were starting to see, as we discussed previously, the easing of the Adelaide market. And Canberra keeps on keeping on, a little bit lower than what we saw a month ago in Canberra with its clearance rates, but still well ahead of where it was a year ago, where they had a clearance rate of just 50%, and certainly higher auction numbers compared to the previous week and to the same week last year. We can see, maybe higher listing numbers are just starting to take an impact on clearance rates, just easing over the past couple of months when we look at monthly clearance rates, Michael, but still well in favour of sellers when you're looking at around about 75% clearance rate for both Sydney and Melbourne. In Brisbane, picked up a little bit. Of course, we're only looking at the first week in November here, so we have some time to run, but still strong results there for Brisbane. Adelaide, a little bit lower than where it was a couple of months ago, but still, once again, mid-70 clearance rates are clearly in favour of sellers market.
And for pushing prices up as well.
Well, that reflects strong competition for property. If you're
Sure.
thinking nearly 8 out of 10 properties selling under the hammer every week, that clearly shows strong competition for property. And we know that that will result in 5 to 10% plus growth with those sort of clearance rates. And we've seen that, as we revealed last week in our October house price report. So Canberra has revived, but the markets are a little bit slightly softer over the last month or so, Michael. Still strong, so we won't be sort of good, but that's the nature of the spring selling season. Typically, we have higher clearance rates at the beginning, lower clearance rate at the end, notwithstanding what the cycle is doing. It is a very strong cycle at the moment, so we're not reading too much into this. I'm not sure there's any fertile ground here for the doomsayers, but I would expect to see clearance rates just starting to ease, continuing to ease through to the end of the year. But Michael, we've only got 6 weeks left, and that's it. It's done.
Wow.
Yeah.
Yes.
So, and this is the get out of jail time for vendors. They're obviously very keen to sell before the end of the year. And some of them actually decide, no, we're going to leave it till next year. But they will be getting, higher prices going forward. We would certainly expect to see prices continuing to rise with 75% overall clearance rates. It is a seller's market. Plenty of competition for amongst buyers. A few more choices coming into the market for buyers over the next 6 weeks, and a bit more competition amongst sellers with more properties. But I would expect to still see prices growth and strong results overall for our auction market for the remainder of the spring selling season, which finishes the week before Christmas.
Wow. Well, interestingly, as you said, some vendors are wondering, maybe I should leave it and wait till next year. There's no doubt prices are going to be higher, but most vendors are buyers. They're going to upgrade, right size, downgrade. And so they're going to enter a market that's going to still be strong and often have to pay more. So maybe the right time is now. Look, thanks. There were some fascinating insights. Clearly, while the headlines keep talking about affordability, inflation, even higher interest rates, which I hope aren't going to happen and are unlikely to, is what you're saying. The real story is the market continues to defy expectations. It seems that demand is resilient, supply is tight, underlying fundamentals are strong. So if you've been sitting on the sidelines waiting, there's never going to be a perfect time. Perhaps it's a reminder that opportunities often appear when others are hesitant. So maybe this is the right time. Andrew, thanks for sharing your expertise. Look forward to catching up with you again next week.
Thanks, Michael.